Hello everyone, welcome to today's US Open live webinar. It is Thursday, October the 12th, 10 minutes before Wall Street opens. As always, I am your host Nikos Zabouras, Senior Financial Editorial Writer at FXCM. The US CPI report that was released just earlier was today's main event and showed that inflation remains persistent, pushing the US dollar higher and applying pressure to Wall Street. We continue, of course, to monitor the Middle East conflict and its impact on commodities, while we now turn our attention to the new earnings season, which is already underway with Delta Airlines results already out, a big surge in profits year over year. That's what we will be talking about today, but as always, please read carefully through the risk warnings and the disclaimers, and then we will go ahead. Once again, please go over the risk warnings and disclaimers, and bear in mind that anything discussed in this session does not constitute investment advice and should not be taken as such. Let's give it a few more seconds and then we will go ahead with our commentary. Okay, let's get the ball rolling because we'll have quite a few things to talk about. You can see the Euro USD reacting negatively to the US inflation figures that were released less than an hour ago. Headline CPI stayed at 3.7% year over year in September, while core eased further to 4.1% from 4.3% previously, in what was the smallest increase in almost 2 years. The results, however, show that inflation is stubborn and well above the Fed's 2% target, keeping more tightening in play despite recent Fed voters adopting a conservative stance, worried over rising long-term yields. The Fed was aggressive after September's hold, and yesterday's minutes of that decision reiterated that hawkish bias. At the same time, the ECB has guided towards the end of hikes, has hinted towards that. We have talked about it again, and this is once again puts pressure on Euro USD. Let's turn to the 4-hour chart for our technical analysis. Not much has changed since our previous session. The pair faces pressure now due to the CPI report at a critical technical juncture. It was trying to move past a strong confluence of resistances above which the downside bias could pose, and would give it the opportunity to push for the 38.2% Fibonacci at around 1.07637. But we said the last time in the previous sessions that it does not inspire confidence for such moves and sustain strength, rebound, given the current monetary policy dynamics. And now, of course, we see that it goes lower. It stays below the 200 period EMA, and bias is on the downside, and the pair is in risk of new 2023 lows, which are located at 1.0447, although bigger losses below 1.0337 continue to have a higher degree of difficulty. As I said, not much has changed since our last analysis. But in any case, we need to see where markets will settle around today's CPI print and this knee-jerk reaction lower, and of course what commentary will come out of the Fed, because we said we had some Fed voters recently that had a dovish bias, which is contrary to the hawkish stance the central bank had adopted after the September's hold. Now let's turn our attention to gold, which attracted safe haven flows. Actually, let's go to gold. As we said, gold attracted safe haven flows after the Hamas-Israel war erupted and benefits from the dollar's recent difficulties due to the dovish commentary we already talked about from some Fed watchers. The commodity posts a relief rally after avoiding new 2023 lows last week and tries to reclaim the 200-period EMA, which is the black line you see right above the price, the current levels. Daily closes above it could pose the bearish bias, but the relative strength index, which you can see at the bottom of the chart, points to overbought condition. And as we have also written recently, the hostile is the upside, is hostile. There are multiple roadblocks with the 200 days EMA, the blue line, the daily Ichimoku cloud, and more. Furthermore, inflation remains elevated, as was underscored by today's CPI report from the US, despite the deceleration in the core. And we saw how US dollar reacted higher, and as such XAU/USD faces pressure. Below the 200-period EMA, the black line, bears are in control, and the road towards 1,804 remains open. Once again, we're gonna need to see how things will evolve, but as things stand now, immediate bias remains on the downside. And with 2 minutes before Wall Street opens, let's head to SP 500, and then we're gonna talk about what's coming up, and we're also gonna talk about Delta Airlines results that were released earlier today. Okay, so SPX 500 has managed to look past the Middle East conflict with the help of the soft commentary from the Fed, and returned above the 200-period EMA, the black line. This gives it the opportunity to push towards the 4,460, 4,475 region. But today's CPI release complicates things because it applies downward pressure, which could shift immediate bias back to the downside, but sustained weakness does not look that easy, with the next major level being quite far right now at 4,171. Here too, not much change from the last analysis. As we continue to see the SPX 500, let's talk about China, because we have the inflation update on Friday from China. The recovery of the world's second largest economy and consumer of oil has been faltering, although recent data has offered some reason of optimism. The country grapples with weak consumer demand, but CPI ticked up by 0.1% in August, still anemic of course, but it was a recovery from the previous negative print. On the producer side, things are worse, but there has been an easing in the inflationary pressures there recently as well. And of course, we expect trade activity, which has been weak. Other than China, we also have UK in the spotlight next week, starting with Tuesday's employment situation. The labour market is tied with historically high pay growth, which feeds into a wage price spiral and creates headache for the Bank of England, which did pause in September, but may have a hard time staying on the sidelines. Now let's talk about the new earnings season, which is well underway, with Delta Airlines posting a nearly 60% profit year-over-year profit surge in Q3 today. It benefits from the post-pandemic travel boom and strong summer demand. However, carriers are now facing rising fuel costs, and the Middle East hostilities could intensify those headwinds. Of course, higher fuel prices eat into the profitability, and Delta lowered its full year outlook. Its stock was up in pre-market following the results, but the stock has entered the fourth straight losing month on high oil prices. Passenger backlash over its loyalty program, some changes there, and of course broader economic uncertainty and tight monetary environment in the US and elsewhere. Of course, focus now shifts to big banks, which follow tomorrow, and then Tesla and Netflix dominate next week's earnings calendar. That's it from me for today. Thank you for joining me. We will talk again next week on Tuesday at our usual time slot, 10 minutes before Wall Street opens.